Welcome back to My Finance Partner viewers. Today we'll be talking a little bit about provisional tax. We'll discuss exactly what it is, when it's due, how it's calculated, and the implications to business owners if they fail to report accurately and on time. So in essence, what is provisional tax? Provisional tax is really a mechanism that SARS has to ensure that they collect tax twice a year rather than waiting until the annual return goes in, which could be up to a year later from the actual year end. So in that case, it would make no sense from a cash flow point of view for SARS to wait, for example, 18 months to actually collect their money. So provisional tax is really there to say, after the first 6 months of trading has happened in a business, please square up your tax with SARS for that period. And then again in the second half of the year, to have a look at your full year and say, where are we in terms of our taxes? Let's estimate where we think we'll be for the full 12 months of trading and pay SARS accordingly. Okay, so in essence then there are two provisional payments and there's an optional top-up payment after the year end that we need to make to SARS. The first provisional payment, and let's assume we've got a February year-end business, which most of you will be, you would, for example, once the 5 months of trading have concluded, so in other words, we've got our results for the period of March through to July, we would now be in the August month reviewing those calculations and looking at the profit numbers and making an estimate for that final month for August. And based on that, we would have to ask ourselves a question and say, okay, we now know what's happened for the first 6 months. How do we think trading will play out for the full year? And then we would need to pay SARS half of that amount. Now, we wouldn't necessarily, according to the rules of the game when it comes to SARS, have to pay 100% of that amount across to SARS. But what we're supposed to do is pay exactly half of that amount. In practice, it's risky doing that because we don't know how the second half of your trading is actually going to go. So we'd make a reasonable estimate and then we'd sit with business owners and we'd make a determination and say, look, we're comfortable to pay 80% of that amount, or we might say, let's pay 100%, we've got the cash now. And that's basically how the discussions would unroll. There is no penalty or any other consequence of getting that number wrong in the first payment. That complication arises with regards to the second payment. That does not mean SARS has no recourse to question you and say, well, why are you submitting a null for the first return? We've had examples of that in the last year especially. And that's for businesses that trade fairly evenly throughout the year, it's not a problem. But for very seasonal businesses where, for example, you only make your profit in the second half of the year, sometimes it can hurt a little bit to be paying your tax in Provisional 1 when you know full well that you're only going to collect your cash in the second half of the year. You're welcome to contact us for a bit of tactical methodology around that, because unfortunately the rule is that you should just be paying half the tax in the first payment. Let's move across to the second payment then. So the second provisional payment is due by the end of February. So typically we should have 11 months worth of financial data at our fingertips at that point. So we should be 11 out of 12 portions accurate, and we're really only looking at February's trading result, where we're playing a bit of guesswork in terms of how that happens. Of course, that is only true if you actually have management accounts up to date, and it's one of the reasons why at My Finance Partner we subscribe to the theory that every business should have a set of management accounts that goes out every month. But assuming we have the information at our fingertips, we would be having the chat with the business owners. We'll be looking at things like cash flow and making a determination then in terms of the amount to pay for provisional tax. Now, for clients that have only recently started working with us, this is often where the fun and games start, because businesses are scratching for cash flow and they're wanting to know what they can do in terms of reducing that bill. So we have a couple of general principles we subscribe to when we look at this, and what we don't like businesses doing is spending money. So for example, if we're going to go invest heavily in stock or anything else, repairs and maintenance, various things that we've been needing to get to that we haven't in order to save tax. And the very simple reason is if cash flow is a constraint for you and you're going to go spend money, let's say you spend 100 Rand, the tax you're going to save on that 100 Rand is going to be 28 Rand. So from a cash flow point of view, it does not make sense to go spending hard-earned business money in an attempt to try and save taxes. So that's one of the things that comes up often. And a second is buying assets. So that's an even worse investment, because typically your assets you only get to write off over a period of, say, 5 years with SARS, and especially if you're very close to year end, you might only get 1/12 of that spend, and then you're going to spend another 4 years and 11 months trying to get the rest of your money back. So we really don't like that as a methodology in terms of trying to save on taxes. Having said that, it's important that we are accurate at provisional number 2, because there are some implications for business owners and some penalties that SARS can apply if we're not accurate. So if I could explain it essentially in 2 parts. For businesses that earn more than 1 million Rand of taxable income a year, they need to get to 90% accuracy with SARS. What does that mean? It means that we will make a determination of how we estimate our taxes to be at provisional 2, and we will pay accordingly. A few months later, anywhere between 6 and 12 months later, the annual financial statements will go into SARS, together with the tax computation and the annual return. And at that point, SARS will be in a position to tell what taxes are actually due versus what you actually paid at provisional number 2. And at that point in time, if you are not 90% accurate, SARS will raise an underestimation penalty on the business of the difference between what you actually paid at provisional 2 and what is actually due to SARS according to your annual return. So that's quite a high impact, and it's something we really don't like doing as business people, is incurring that kind of a penalty. Remember, you don't even get the tax deduction for the penalty, so it really is just wasted funds. Okay, so if you're a business then that earns below 1 million Rand per year, you have a choice to make when you calculate your provisional number 2. One choice is to go and look at what is referred to as the basic amount. The basic amount, assuming your accounts are up to date, you're compliant, and your last tax return was filed when it was supposed to be filed, the basic amount would be equivalent to what you submitted last time for taxes. So your last assessment. As long as you use that exact amount, even if your financials later show that you've made a whole bunch more money, SARS will not raise an underestimation penalty. You will be in the clear. You'll obviously need to square up and pay SARS according to those financial statements when the return goes in, but there's no underestimation penalty for you. The other option is, if you're having a really tough year and you decide you're going to submit more accurately on the result that you think is going to be the case, provided you get to within 90% accuracy with SARS, so they give you a little less leeway because of the basic amount, then there will still be no underestimation penalty. If, however, we don't use the basic amount, we underpay in that, and we're not more than 90% accurate at the end, then SARS will raise that penalty on you, and again, it will be on the difference between what you should have paid and what you actually paid, multiplied by 20%. Okay, so a few of the relief measures that SARS has in terms of wear and tear allowances, so depreciation. So I mentioned earlier, as a general rule, it takes you 5 years to get your money back from SARS for assets. There are some exceptions to that rule. So if, for example, you are a small business corporation, again, we'll have a video on that topic that you'll be able to check out to get more info. But essentially, if you only own one business, your turnover is less than 20 million a year, and you're not essentially selling your time, you could potentially qualify as a small business corporation. And if you did that, and you were a business that manufactures, you would be able to write off 100% of your assets purchased in the year that you purchased it if you're an SBC business. If you're just a small business corporation but you're not manufacturing, maybe you're in services or something like that, or retail, then you still get favourable wear and tear allowances, and there you would be allowed to deduct 50% of the cost of that asset in year 1, 30 in year 2, and 20 in the last year. Please bear in mind, when taking accelerated wear and tear allowances, it's always great in those first few years where you get to write the tax off. What happens in future years is you'll continue to make profits, but you won't have the offset of the wear and tear allowance. So you will basically always pay the total taxes due. It's just a case of you get relief in earlier years and you'll feel the pain in the later years when you do that. Also for businesses who are, if you're a business that is going to own a building, so maybe you have a property investment company and you're considering getting an industrial building, there are allowances there as well that you will be entitled to claim on the building, which helps a little bit. So for example, if you construct or purchase a business that is in the process of manufacturing, then in terms of Section 13, as long as that building is older than coming into effect January 1989, you'll be able to claim a 5% per year allowance on that building. There's a newer provision as well, so from April 2007, there's an allowance of 5% as well for a building as long as it's a commercial building and it's used mainly or wholly for commercial purposes. Then you'll be entitled to deduct 5%. Also, just bear in mind in terms of timing of when these returns are due. Your first provisional is end of August, second provisional is end of Feb. By rights, your financials should go in 6 months after your year end. That's what the Companies Act says. But in practice, SARS allows you about 11 months before they'll start raising administrative penalties on you. So basically by January of the next year, end of January, you would have need to have filed your annual return as well. Thank you for listening and checking it out. I hope the video has been useful. Maybe as a parting shot, please, when you're doing your provisional calculations with your providers and considering various options, please note if you take any deposits from customers, so if people pay you in advance, SARS is entitled to tax those amounts at the earlier of when they accrue to you or when you receive them. So that's just something to watch out for if you're a business that takes big deposits. And then the second thing is you cannot claim for expenses that are yet to come, so for future expenses. So any things like, well, we suspect that we're going to have a warranty issue down the line, we have it every year, we don't know the exact number, but we can estimate it with reasonable accuracy. You cannot claim those things for tax purposes. So just bear those little things out when you prepping your tax return, or you might be in for a surprise at a later stage when your financials go in. That's it, everyone. Please also check out our video on the role of tax when applying for funding, and we'll catch you next time.